welcome to Kirti Rane classes. In today's video, we are going to talk about a topic, scope of financial management. But before we start this topic, I would like to let you know that if you want the explanation of this exact same topic in Hindi, please check out my channel playlist. You will get the explanation of this exact same topic in Hindi by me. So let us get started with today's video. In today's video, we are going to learn about the topic scope of financial management. How much does financial management cover? So let us get started. The points you have highlighted perfectly map out the modern scope of financial management. Instead of just looking at finance as a clerical job of keeping track of cash, this framework covers everything from initial spark of an idea to daily control of operations. So it tells you that it is not just a simple overlook of the finance of any business. It starts from the spark of the idea. The moment you inspire to start that particular project or particular business to how much you actually spend on it and how much do you get the return, right? So it is a vast space of knowledge, and it covers everything, right? Financial management covers everything. Now in this topic, we are going to view the following points, which is the following aspects: the financial planning, establishing financial policies, raising finance, procurement of funds, utilization of funds, that is investment decision, distribution of earnings, that is dividend decision, and financial control. These are the 6 aspects of the scope of financial management. So let us look at that one by one. But before that, please take a screenshot of this slide so we can move on to the next point. Moving on to our first aspect of financial management, which is the financial planning. Now, what does the financial planning covers? Before a business can spend or raise a single dollar, it needs blueprint. Financial planning involves forecasting the company's future financial needs and determining the quantum, that is the total amount of capital required. Now, what does financial planning include? It includes forecasting the company's future needs, right? Here we have seen the company's future financial needs and determining how much of the quantity of finance would be needed for the company. Now, this is further categorized into 2 parts, which is the short-term planning and the long-term planning, because you may have a different needs for your short-term and different need for your long-term. When you focus on long-term planning, sometimes you would have to keep a hold on distributing dividends or raising the salaries, right? The incentives. But if you're looking at the short-term planning, you will have to raise we will give out more dividend, or you will raise the salary of your employees for the benefit of the company. So this is financial planning. Now let us look at these points one by one. So what is short-term planning? Now, estimating the working capital needed for day-to-day operation, for example, raw material, wages and inventory, comes under the short-term planning. And what does the long-term planning include? It includes the calculating the funds needed for fixed assets, expansion or new research and development, that is R&D projects. Now, we have categorized what kind of forecasting. If you are forecasting for your day-to-day operations, day-to-day activities, then it would come under the short-term planning. And if you are forecasting for your R&D project, for your expansion, for the growth of your business or company, it would come under the long-term financial planning, right? So this was all in the first point, the financial planning. Please take a screenshot so we can move on to our next point. Now, the second aspect of the scope of financial planning is establishing financial policies. Now, what does the establishment of financial policies actually mean? Let us look at it. The financial policies act as a rule book for a company's financial behavior. Management must establish clear guidelines regarding credit, borrowing, and cash management to ensure consistency and safety. Now, what are the examples of this policy? Defining the credit period allowed for customers, that is the next 30 days credit period. Whenever a retailer buys the stock of goods, a wholesale stock of goods from the supplier, they get a 30-day period, that after 30 days, when the goods are sold after a month, you will pay for the goods that you bought 30 days before, right? That is the 30-day credit period. Now, setting the minimum cash balance to maintain at all times, setting debt to equity ratio limits to avoid over borrowing. Now, this was an example for the financial policies. Now, what does this point trying to say is that management must establish some policies, some rules regarding finance, right? You cannot just lend money to your debtors unlimitedly. You cannot borrow money as well. So whenever, and from the point of view of producer, you will have to set a rule of the debt to equity ratio, right? You will have to set a rule that after what amount of time would the debtor have to pay you back, right? So that your company can survive in the market, right? So that includes some of the policies. So here we can, let's go through it. The management must establish clear guidelines regarding these three main points, which is credit, borrowings and cash management, to ensure consistency and safety. If you do not pay attention to the credit borrowings, you will end up borrowing more money, or you will end up lending more money, and therefore you could go into loss, right? So there is no consistency, there is no safety. And if you do not properly oversee your cash management, that how much liquid cash do you keep to yourself, and how much do you actually invest in something else, right? So that would also lead to be a threat for your business. So this was the establishment of financial policy. Please take a screenshot of this slide so we can move on to a third point, the third aspect of scope of financial planning. Now, the third aspect of the scope of financial planning is raising finance, which is also termed as procurement of funds. Raising finance or procurement of funds is that whenever you would need funds, from where would you take it for your own business? So let us see what is. So once the requirement and policies are set, the finance manager must source the capital. The scope here involves selecting the absolute best mix of fund, that is capital structure optimization, which we have seen in the previous video is known as the capital mix, to minimize the cost of raising money while keeping financial risk under control. Now, there are two types of capital under it. First is the owned capital or the owner's funds, right? It includes issuing equity shares or retaining profit, right? If a business is earning profits and you keep it within the business for future use, that is the retained profit. And whenever the owners, that is the shareholders of the company, invest more in the business, that also comes under the owned capital. The second is borrowed capital. Now, taking bank loans, issuing debentures or corporate bonds includes under the borrowed capital. As the name suggests, if it is not owned by you, you have taken it from outsiders, right? The external factors like the banks, like the external investors, right? If you are issuing debentures or bonds, so that would come under the borrowed capital of your capital structure. Now, this point is trying to convey that if you can maintain an optimal capital structure in your business, you can actually successfully see the scope of finance management. In this particular aspect, the scope covers the structure or the mix of the capital that you keep. How much owner's fund, that is own fund, is there in the capital structure, and how much borrowed funds is there. There should not be much borrowed funds. There should, right, that it creates a liability. It actually does not help you increase the EPS of the company, right, the share market, because what is the main importance or the main objective of any business or for the aspect of financial management, that is the wealth maximization concept, right? So if the more the debt is there, it is decreasing your wealth or the market price of your company. That is not optimal. So that is what you need to look into. So this was the third point. So please take a screenshot of this page so we can move on to the next slide with the fourth scope of financial management, the fourth aspect under the scope of financial management, which is the utilization of funds, or technically known as the investment decision. Now what does the utilization of funds actually mean over here? Let us see that. Now raising money is only the half battle. The real test is how wisely it is spent. Finance manager must allocate funds into assets or projects that yield a return greater than the cost of raising that capital. Now in that investment decision, there are two types of decision under it. The first is the capital budgeting, applying rigorous evaluation tools like NPV or IRR. Now NPV means net present value and IRR means the return on investment, right? So to decide the long-term investments like buying land or upgrading technology. So these are some tools used under the capital budgeting decision. Now what is capital budgeting decision? Whenever you plan on buying a new building, a plant, a factory, a land, that is a huge investment, right? It requires a much more amount of money, and the return of it would not be gained under a single year. It would take more than a year to gain the return, right? To recover the amount you have invested in. That's why it is known as the capital budgeting decision. Okay, so some of the tools that are used in the capital budgeting decisions are NPV and IRR. So that they help you find out how much time would it require for you to get the return or to retract the amount that you have invested in that particular asset. The second is working capital management. Now managing current assets efficiently so that capital isn't locked up unproductively in excess inventory or unpaid customer bills comes under the working capital management. And now as the capital budgeting was for the long-term assets, right, the fixed assets, the big assets in which the return, you will not get the return of the amount you have invested in within a year. But in the working capital management, you will get the return of the amount you have invested within a year. It is mainly related to the current assets of any company. Now the current assets, you know, the assets which are only for over a year. It does not exceed 1 year, right? So whenever you invest in those type of assets and you need to take a decision related to that, it would come under the working capital management. Now what does this point trying to say is, whenever you procure the fund, that is not enough. You need to know where and how much are you investing it, because if you are not investing it wisely, the investment could be as good as a loss, right? So you need to evaluate the risk. You need to see how much a return would you get if you invested that amount of money in that particular fixed assets or current assets, right? So you need to evaluate everything. That is this aspect trying to say the utilization of funds or investment decision. Please take a screenshot of this page so we can move on to our next slide. But now our fifth aspect under the scope of financial management is right over here, which is the distribution of earnings or the dividend decision. Now why does this distribution of earning is termed as a dividend decision? Because what does company earn? A company would earn profit, and how would the owners get will get an appreciation for their investment? They will get in the form of the dividends, right? Because shareholders are the owners of the company who invest in the company. So the profit are distributed as dividends. Therefore, the distribution of earnings is termed as the dividend decision. Let us see what exactly does this point entail. At the end of financial year, the company generates a net profit. Financial management decides what happens to this surplus. This is a delicate balancing act between keeping investors happy and keeping the business funded. Now, under this, there are further 2 points, which are the dividends. What are dividends now? It is paying a proportion of profit out of the shareholders as a reward for their investment in the firm. Because they are investing in our firm, they are trusting our firm, our business, our company, we would have to show them appreciation, and therefore we give them a small amount of our profit, a part of the net profit as dividends, right? So that is dividends. Now what what is the second part of the profit? Now part of the profit you have given as dividends. Now what is the rest is going to termed as? It would be termed as the retained earnings. Now let us see at the technical definition, that is flowing the profits back into business reserves to fund future growth without taking on new debt. Now whenever a business earns profit, right, so it is a profit, right? Now when you take that profit and invest it back into the business, it would be termed as the retained earnings, right? Therefore it is known as the plowing, because whenever you plow, whenever the farmers plow, the heap of the soil, it gets yanked back into the same hole, right? Therefore you are plowing the profit back into the business, therefore it is known as the retained earnings, right? So the profit here is divided into two parts. First are the dividends and second are the retained earnings. So you need to keep and balance between how much dividend are you going to provide this year and how much of this are you going to retain. How much would be needed to keep the investors happy as well as keep the business funded. Because if you divide 100% of the profit as dividends, there is nothing for the business to be funded, right? There is no funds for the business to continue operations for the next year. But if you retain all the earnings, all the profit, the investors would be unhappy, because what are they getting? If the company is earning that much profit, as an owner, they are not getting any return, right? So you need to keep a delicate balance between these two, and that is what all the dividend decision is all about. So this was the fifth point, the fifth aspect. Please take a screenshot of this point so we can move on to our next slide. And the last point in scope of financial management. So the last aspect of this in the scope of financial management is financial control. Now what is this point trying to say? The final phase of scope ensures that everything goes according to plan. Financial control involves monitoring actual financial performance and comparing it against the predetermined budget. Now in this we can see there are some management tools that are used for the financial control. It is not just enough that you invest everything, right? You take an investing decision, you take a dividend decision, right? You take a decision about the procurement of funds. You need to control it, right? You need to oversee that whether your funds are actually really benefiting the company or not. So there are certain management tools like it is given over here. So utilizing techniques like ratio analysis, cash flow statement and variance analysis to spot overspending or financial leak immediately so that corrective actions can be taken before it's too late. Now why are these management tools important? Because of financial ledger, right? The financial things like the trading account, the P&L account and the balance sheet, they do not give us the exact how our cash flows through the company, right? What are the ratio? They do not take, because it includes non-monetary quantities like depreciation and so there are things like depreciation, then whenever you do not provide salary, right? This outstanding salary, etc., the rent received earlier in this year, so that all is subtracted and added within the financial statements. Therefore, we need certain tools like the ratio analysis, cash flow statement and variance analysis to actually know how that cash flowed throughout the company. Is it beneficial? Is there any kind of leakage or not, right? So you would need to know, you would need to pinpoint that. That's what all financial control is all about. So here we have completed the description of all the 6 aspects or the steps in the scope of financial management. So let us move on to the summary, but before that please take a screenshot of that page. Okay, so here the scope as a continuous cycle. So here the scope of financial management is shown as a cycle, is a continuous cycle. All the 6 steps that we have discussed are shown here in the cycle. So 6 areas that we mentioned do not operate in isolation. They form a continuous management loop. So it is given as below. The first is the financial planning, right? First you will plan how much finance are you going to need, right? Second is the establishment of policies, right? You need to set the rules and regulation on how to use that finance, how to secure your company so that your business stays safe and control, right? The next is raising finance. The third point over here after that is raising finance. That how will you raise finance? You would need the actual money to control it, right? To take decisions. So raising finance. Then you will go to the next point, which is fund utilization. How you utilize those funds, right? The investment decision, right? The next is the distribution of earnings. After using those funds, you will obviously earn something, the net profit, right? Now how you will distribute it, right? The dividend decision, how much dividend would you give, how much would you keep with it, the company as retained earnings. And the last step is the financial control. Now you will see where are there any leakages, is everything went as planned or there was something else, right? So you will learn from those financial controls, and for the next year's planning, which is whenever you make a budget, you will learn from the financial control, right? They will give some observations. You will use that observations to make your financial plan better. So this is how the continuous cycle or the continuous management loop works in the scope of financial management. These 6 aspects of the scope of financial management do not work in isolation but in this continuous loop. Please take a screenshot so you can understand it better, right? So it is a diagrammatic representation. With this, friends, our topic, the scope of financial management, has been completed. Now before ending the video, I would like to remind you that if you want the explanation of this exact same topic in Hindi, please check out my channel playlist. I have explained this exact same topic in Hindi, so please view that video as well. Thank you for watching this video. If you like this video, please like this video, subscribe to my channel for further updates, comment under it how do you like this video and share it with your friends. Thank you.